Hello dear retail traders, first of all, welcome to my blog. I am very pleased that you have found my channel on the subject of stock exchange trading. Today's video should give you a brief overview of what content you can expect in the next few months. My name is Michael, I am 56 years old, and have been trading on the stock exchange for over 10 years. I am one of the 2% of professional Forex traders, who are allowed to trade with a leverage of up to 1/500 within the ESMA regulations in Europe. In the last 8 years I have strategically developed from day trader to short-time trader, while my cumulative screen time has reached almost 40,000 hours. Since my strengths lie in the area of creativity, I have developed many things in recent years that give me a deeper insight into the market today. I am happy to share this information in order to find like-minded people, but I will deprive myself of the right to choose these people well. Exchanges have existed for over 600 years, and during this time no trader has succeeded in developing a reproducible concept in order to achieve constant profits. There isn't a day trader on the Forbes list who is among the richest people in the world. I do not want to suggest that I can change these facts through the way I trade, nor do I suggest that my view of the markets is correct. Every trader has his own opinion, which I absolutely accept and respect. Incidentally, I expect the same from others. So my future statements on this channel are only my personal opinion. I always accept discussions about further development. I categorically reject discussions on the basis of vanity. The main reason that I do not speak with a camera in the picture corresponds to my conviction that trading and not me should be the focus on this channel. We come to the crucial point. What makes me different from other traders? I only trade in the Forex market, but do not make my trading decisions from Forex data, only from stock exchange data. News and the price are completely irrelevant to me. I do not make trading decisions based on candles, the price, volume or indicators, but exclusively from the identification of the big player algorithms. In theory, it is possible to trade profitably with my approach without looking at the screen. These are the topics that we will deal with in the next few months. In the 30 minutes that follow, I will give you a few more summarized explanations. Every beginner and advanced Forex trader has spent a lot of time analyzing indicators, systems, setups, or certain strategies. One tries to identify certain pattern structures in order to derive a concrete trading decision. We know the best known pattern identifications from the candle formations. Doji, hammer or morning star are just a few examples. Likewise, many traders follow certain pattern structures that take place within different indicators or in the course of prices. The best known indicator is the moving average, which is intended to help with future forecasting with an average calculation. Basically, a moving average is a tool for identifying market trends, but it is a trailing indicator. It can only show a trend after it has developed, and it also shows a trend that has long since ended. This automatically brings delayed market insights, and therefore the profitability of the moving average is rather sobering. First of all, it is important to find out what kind of data we are getting in the Forex market. The most important information is the price of the current course. With the help of time, a candle in the form of OHLC is formed from the price information. In MT4 there are 9 different time units that the majority of traders use. We now have 2 pieces of information, price and time, from which a candle is formed. Since the time is fixed M1, M5, M15, the price information mapped from it will always create a random candle that looks different for each broker. If the candlestick formation from the price is a random representation, it should be clear that no clear pattern recognition can be derived from it. Now we come to the indicators. Most of the indicators relate to the price within a fixed unit of time. Basically, all indicators lag behind the price, so that one cannot expect any advantage for a better trading decision. In this respect, the same applies to the indicators as to the candle. This is just a random representation. It is impossible to derive a clear pattern recognition from a coincidence. Of course, there are traders who do not work with time-dependent charts, such as Renko or tick charts. However, these representations do not bring any decisive advantage either. The background is as follows: the price that we receive in the Forex market is only a result. The actual cause lies in the market sell orders which run in the limit buy orders and the market buy orders which run in the limit sell orders. And it is precisely this information that we do not receive in the Forex market. There is the possibility to make a volume visible in MT4, but this has nothing to do with the actual total volume of the market. In addition, correct volume information in Forex would not help us, as the volume is only an addition of bid and ask. However, bid and ask have nothing to do with each other and never meet in the market, so you always have to consider these factors separately. Even when I examined the tick charts in the Forex market in detail, I could not identify any clear patterns. A tick shows us a time-independent trading transaction, but we do not receive any information in the Forex market about how much lot has been processed within this trading transaction. And we also don't know how this lot is divided into ask and bid. So we come to an interim conclusion. If candles or indicators in this market are created only by chance, by the given time, a concrete pattern identification is automatically impossible. Even with the beginning of computer technology, countless programs and indicators were developed to find possible patterns. So far, no special patterns have been identified in the price that could provide a reliable price forecast. This fact alone led me to look for other avenues that have not yet been explored. Forex Factory is undoubtedly the largest website for Forex traders, with over 750,000 members, as evidenced by its 1.5 million daily hits. Almost 20% of retail traders worldwide have an account here. The platform is free and anyone can register there to post. At Forex Factory you will find 9 different forums with over 70,000 topics. If you enter my name in the search bar, you will automatically come to my blog. When I opened my blog at Forex Factory 3 years ago, I chose the name Bionics. Bionics is based on the assumption that living nature develops optimized structures and processes from which humans can learn. The Earth is almost 4.5 billion years old, and during this time nature has developed incredible things that we are already benefiting from today. A well-known example of this is Leonardo da Vinci's idea of transferring bird flight to flying machines. Or let's think of dragonflies and the helicopter. The lotus effect was also brought into our lives by nature, things that clean themselves because no dirt adheres to them. The idea of transferring from biology to technology is the central element of bionics. Anyone looking for a new innovation should always steal from nature. On the stock exchange too, the laws of nature prevail, from which we can learn every day. In the last 3 years I have published almost 1,000 articles, programmed some MT4 indicators myself, created 1,800 images to pass on my ideas to interested traders free of charge. All contributions are written in English, but you could simply have them translated into German. Copy the link on my site and enter it in Google Translate. Then my contributions will be translated into German. Why am I ready to give free information? In all honesty, I primarily did this for myself. At first I just wanted to keep a trader's diary to document my progress. In addition, I was able to significantly improve my English skills. When you have implemented an idea in the trading area, you logically know the specific process, and you no longer need to explain this procedure yourself. It becomes problematic as soon as you try to explain your idea to other people who don't think like you do. To do this, you have to use pictorial language and go deeper into it so that most people understand it. Later, I was able to use my blog to move forward faster. When I promised to publish a certain post to the people who followed my blog, I was automatically forced to deal with exactly these specialist topics in order to keep my promise. For the last 3 years I have been doing my master's in Java on the side to understand how indicators work, and even programmed my own MT4 indicators. All of this has brought me forward enormously in recent years. Now comes the next step, from blog to YouTube channel. Producing a video is a new challenge for me, as well as conveying complex things in an understandable way in my linguistic mentality. We'll see where this leads. I link the links from Forex Factory and my collected videos to you here in the description. Since the dollar is involved in 88% and 38% of the euro in all foreign exchange trading, the EURist is the most frequently traded currency pair in the Forex market and the Euro FX in the futures market. Adding the daily capital flow in both markets adds up to over $2 trillion. That's a third of the total Forex market. On average, Euro FX trades 150,000 lots per day, so the futures market is only 1%. That said, the Forex EURist is almost 100 times larger than the Euro FX. 99% of the market is not regulated by exchanges, and only 1% of the total turnover provides us with specific exchange data. In fact, it would be unwise to assume that one could use the Euro FX exchange data to make specific assumptions about the EURist Forex. However, since the EURist is linked to the Euro currency market via the swaps, my assumption was not completely wrong. I did a candlestick comparison in H1 between the two markets and found that the moves are almost identical. Next, I wanted to know how the markets relate to one another in a very short time. Since the ticks on the Forex market are significantly smaller than on the futures market, I had to make an adjustment for a comparison. In the background you can see on the left the futures market in a time unit of 4 ticks, and on the right side the Forex market in a time unit of 16 ticks. The course was initially in a small equilibrium and then decreased a little. It was interesting, but not surprising, that the two courses ran almost parallel in a very short time. This information gave me another reason to get more involved with this project. The aim was to compare the Forex data and future data in such a way that, due to the better information from the futures market, successful trading on the Forex market is possible. The chance of winning in the Forex market is 1/19, which means that the winner receives the loss of 19 losers. In the futures market, the chance of winning is 1/6. One winner receives the loss of 6 losers. The chance of winning in the futures market is 3 times higher than in the Forex market. However, the profit ratio is lower. My idea: trading in the Forex market based on the data of the future market. We start at point A. A falling price is initially slowed down by the peak of sales. Now the accumulation phase arises. This accumulation phase is caused by increased institutional demand. The price is initially moving sideways, the price structure varies. Within this range, the big players try to acquire contracts at a favorable price. In addition, you are trying to mislead the smaller trader that the price may go further down. During this accumulation phase, you will find that the volume is relatively small, although the authority of the cops is in the foreground. Before the price goes up through the accumulation channel, there is what is known as a false breakout down. This breakout below is actually not wrong, but was created quite deliberately. Within this accumulation channel, there are traders who know exactly that it is an accumulation. In doing so, they are positioning themselves for a possible upward trend. With the breakout down, the big players try to reach the stops of these ask traders. As soon as the stops are triggered, the price makes another small jump down. Stopping a buyer automatically becomes a sell order. For many small traders, this is now a sign that the price is going further down. The big player pushes the course upwards after stop fishing. All small traders will be stopped from immediately. In order to ensure a smooth process here, the big player uses specially programmed algorithms that are precisely tailored to his market orders and limit orders. These sideways movements are also very interesting for scalpers to trade. It is much more interesting to find out what the big players are up to within this sideways movement. The big players determine the market and use the limit orders for their entry and exit, and need the market orders to drive the market in the desired direction. To fill their limit orders, they always look for the volume that is most efficiently found in retailer stops. With the help of the iceberg orders, the big players can add further limit orders unnoticed and thus collect ask or bid without being noticed. Interestingly, the average of iceberg orders is between 10 and 20 lots and not, as we previously thought, by an extremely high number of lots. Of course, there are also extreme absorptions, but they only arise because a large player makes volume available to himself. The iceberg orders have been studied in great detail by various analysts, and it turns out that iceberg orders accounted for 20 to 50% of total sales. Many small iceberg orders at different price levels make it difficult to precisely identify. the absorption and continue to help the big players to dominate the market undetected. As soon as a big player has completed his collection campaign, he prepares to move the price in his trading direction. To push a price up, the big player usually has to invest a large number of asks in the form of market orders. To avoid this situation, he already places 5 to 10 sell limit levels up to 30 minutes in advance with his iceberg orders. In the DOM we only see 50 lot limit sell orders at one price level, but behind that there are further limit sell orders that are waiting to be followed up. These iceberg orders are invisible to most traders, but I have found a method how to identify these iceberg orders as a retail trader and read them out at every price level. I'm already considering writing an algorithm for this project. In addition to the limit orders, we would then always see the current iceberg orders in the chart. With a special calculation, it is also possible to differentiate the native from the synthetic iceberg orders. Even the big players are currently failing because of this problem because they are unable to do so. Just before the big player pushes the price up, the algorithms withdraw the limit sell orders that were previously placed in the market. At the same time, the market buy algorithms begin to shoot into the market. With this little trick, the big player succeeds in pushing the price up massively with just a few lots. To push the price up by 10 ticks in Euro FX at the moment, you normally need 600 lots. With this little trick, the big player only needs around 100 lots. The background to this is as follows. First, the big player collected 500 lot ask at a price level in order to make a profit. If he now pushes the price up and had to spend 60 lots for a tick, the game would no longer pay off. In addition, we must not forget that he will have to get out of the euro again at some point. The less solder he has collected on the way up, the faster he is out of his position. Now we come to a very interesting point. The big player algorithms were individually tailored to the behavior of the retail trader. These behaviors are always the same, so the big players are also able to use these algorithms on a regular basis. They are very complex to program because they require a specific coordination for the market orders, limit orders, and also iceberg orders. It should be logical that recurring patterns are to be identified within these algorithms. The first problem is that there are different algorithms for different approaches. The big advantage here is that the algorithms are adapted, but not completely changed. This means that the resulting patterns do not change much. I have already started to identify the individual patterns, and have found 30 different patterns so far. Interestingly, the patterns arise again and again in the same situations, from which one can create the following strategy. You have to think of these patterns as a kind of cooking recipe. First, the ingredients are put together in a certain order, then mixed together, and finally the mixture goes into the oven. If you know the recipe exactly and receive the information that the ingredients are currently being mixed, you automatically know that the mixture is about to go into the oven. Since the algorithms are always based on one another, you can immediately see in which phase the big player is. This allows you to clearly predict which step the big player will take next. This allows trades to be calculated precisely, and the risk is significantly minimized. So you don't get in the middle of the breakout, but are there from the beginning. If you want to identify patterns, you only have one chance to make the patterns of the algorithms visible. These patterns only appear in the DOM and in the time and sales list, since both representations are independent of time and volume. In addition, you need special software that allows us to set unlimited filter settings. But even with the appropriate software, you are still a long way from achieving your goal, as you first have to find the optimal filter settings. First of all, I started with very elaborate filter settings to identify the big players' algorithms. For this I tried out all the charts and setting options in order to get closer to the goal. In addition to an MT4 with its own indicators, after a long search I found one of the best platforms for the stock market that I think is currently available. This stock market software is a professional trading and analysis platform for order flow and liquidity trading and offers many functions for quick and easy market analysis. The range of functions includes very extensive filter options as well as flexible and dynamic setting options. For me, that was the main reason why I use this platform. In addition, the new platform uses the graphics card's GPU to perform arithmetic operations up to 20 times faster. At the same time, the CPU is relieved and can take care of other things. I supply this platform with a data feed from CQG. CQG has the advantage over Rhythmic that the volume data is added in a new CME data format. Our sense of hearing reacts 4 times faster than our eyes. Nevertheless, we only act with our sense of sight. We can see 3-dimensional charts with our eyes, but the response time will always be too slow. That's why I want to focus on my hearing in the future. Our two brains react differently to signals, and this property can be used excellently for this. What matters is what type of information we receive, and how it specifically affects our senses. The big players and high-frequency traders are investing millions of dollars in using microwaves to reduce latencies from 15 milliseconds to 5 milliseconds, which, however, is of little benefit due to the limited sensory stimuli, sense of sight. What use is a tuned vehicle that can reach 200 miles if the road is damaged and does not allow such speed at all? A change from visual stimuli to acoustic stimuli has significantly greater advantages and is considerably cheaper. The first clay tests have already been completed and have produced interesting results. In the meantime, I am already working with 8 different tones to simulate a kind of 3D tones. However, this procedure also requires special training, since at the same time the sense of sight has to be shut down completely. That sounds completely crazy at first, but when people talked about going for a walk on the moon one day in the 50s, they also thought they were crazy. Maybe this idea is the first step into a new future. It would theoretically be possible to act without looking at the screen. If you look at a broker's website, you can find there the retail trader's loss rate. Since there is no standardized calculation, the figures cannot be compared with one another. The truth, however, looks much more dramatic. 90% of traders lose money over the long term. 5% reach the break even and 5% can live from trading, although there are also big differences here. The first goal: don't try to make much money, try to lose no money. Who achieves this belongs to the top 10% of all traders. Success depends on experience, and experience in turn depends on screen time. The number of trades placed in the real money account also plays a major role. In my opinion, a trader needs about 10,000 screen hours to break even. If he gets 10 to 12 hours of screen time every day, he can reach the break even after 3 years. A part-time trader who spends 5 hours a day needs 6 years for this. To reach the profit phase, it takes between 6 to 12 years, and a professional trader achieves his goal after an average of 9 years. A doctor, notary, or lawyer also needs 7 to 10 years of training in order to earn above average afterwards. A trader who dreams of earning an income similar to that of a doctor, notary, or lawyer should be ready to make the same investments and efforts. The crucial step for a trader is to come from the losing phase into the break-even point. Once the break-even point is reached, he is able to use his money management and other factors to optimize the levers so that he gets into the profit phase more quickly. The main reason most traders lose is primarily because of the information they get from the market and how they interpret it. However, if the information is incorrect from the outset, even the best interpretation is of no use. In the Forex market, we see a bearish candle, but we are not able to find out whether it is a dollar purchase or a euro sale because we cannot look into the candle. In the future market, we are able to look into a candle, but even there we only see the past. In the DOM we can see 20 levels of the limit order, but the crucial iceberg orders remain hidden from us. The moment a trader deals with the identification of the algorithms, he is able to identify some of the iceberg orders more quickly. This significantly increases his probability of winning. The identification of the algorithms is one of the ways that a trader can break even after 1 to 2 years. At first glance, that doesn't seem like a big advantage, but one mustn't forget, the sooner you reach the break-even point, the fewer losses you incurs. A trader who takes 3 years to reach the break-even point makes loses for 3 years. A trader who reached the break-even point after a year and a half not only saves time, as he will make a profit earlier, but also some losses. And in the end, that is exactly what makes the difference. There are many things in a trader's life that are critical to success. For example, did you know that a downtrend in Eurist is around 30 to 40% faster than an uptrend? Which indicators are really valuable in the Forex market, and how should I use them? How can I calculate the currency pair that is optimal for me? Which trading setup is best for me? As a trader, how do I plan my optimal daily routine? What do I need to know about brokers, and what should my risk management look like? How do I manage to create an optimal workplace with as little money as possible that meets all the important requirements at the same time? Which workstation is the best, and what do I have to pay attention to on the internet? How do I manage to set my software so that my ping times change optimally? All of these will be topics that we will deal with over the next few months. If you feel like it, just subscribe to my channel and you'll be part of it. Throughout my life, I have always made sure to optimize certain process structures that have hindered or stopped me. Here you can see a normal candlestick chart, which at the beginning confused me more than it helped me. Each candle consists of 4 pieces of information: open, high, low, and close. With the Bionic Candle, I have developed a candle that does without the open. This means that only 3 different pieces of information are transmitted, and you save 33% of the time, although you get the same information as in the normal candlestick chart. We will talk about this again separately. No matter how complicated or difficult things are at first sight, when you figure out how to deal with them, suddenly things are very simple. Maybe in the future I can do a part to make things easier for you to see. The best books, by the way, are those that every reader thinks he could have written himself. I sincerely wish you achieve your goals, and I would love to see you get some trading advantages from my future posts. Kind regards, Michael.